Real-world assets on blockchain, revolution or trap? Imagine a world where you can buy a fraction of a Manhattan skyscraper with a few clicks, or own part of a Picasso painting without ever setting foot in a museum. That's not science fiction, it's the promise of tokenizing real-world assets on the blockchain. From real estate and commodities to government bonds and luxury goods. Everything is being repackaged into digital tokens. Financial giants, crypto startups, and even central banks are jumping on board. They call it the next evolution of finance. The buzzword? RWAs, real-world assets. But here's the question no one's asking loud enough. Is this truly a revolution in ownership and liquidity, or just another trap designed to lure investors into a digital black box? At Money Minded, we cut through the noise. Because behind every promise of financial freedom is a risk that could go unnoticed, until it's too late. In this video, we'll unpack what real-world assets on the blockchain really are, how they're transforming the investment landscape, and why some experts are warning of systemic risks hiding beneath the surface. We'll also explore who benefits the most from this trend, and spoiler alert, it might not be you. Whether you're a crypto believer, a traditional investor, or simply curious about where money is heading, this episode is for you. Stay with us, because what you're about to discover could change how you see the future of finance, and your place in it. Don't forget to like, subscribe, and share this video from Money Minded, where global finance meets fearless insight. Chapter 1. What are real-world assets on blockchain? To understand what's really at stake, we first need to get clear on what real-world assets on the blockchain, often abbreviated as RWAs, actually are. At the most basic level, a real-world asset is any tangible or traditional financial instrument that exists in the physical world. Think real estate, gold, government bonds, fine art, or even invoices and private equity. These are assets with real-world value, backed by law, regulation, and often centuries of institutional trust. Tokenizing them means digitally representing those physical assets on a blockchain. In practice, a token is created that serves as a claim on the actual asset or a fraction of it. These tokens can then be traded, transferred, or used as collateral, just like cryptocurrencies or NFTs. Take real estate, for example. Instead of buying an entire building, you can now purchase a token that represents a tiny share of that building's value. That token lives on a blockchain and gives you, at least in theory, rights to rental income or a cut of the appreciation in price. In the case of tokenized government bonds, you might own a token that entitles you to yield from a specific treasury note, with transactions settled on-chain rather than through a traditional broker. This process creates something powerful. Liquidity. Traditionally, real-world assets like real estate or collectibles are illiquid. They take time to buy or sell, involve paperwork, and are typically restricted to large investors. But tokenization makes them tradable 24/7 on global digital platforms, instantly and in small denominations. This opens the door to retail investors, global capital, and automated finance, a world where you can own a slice of anything, anytime, anywhere. Behind the scenes, this is all enabled by smart contracts, self-executing code that enforces the rules of ownership and transfer without intermediaries. That's the big promise: cut out the banks, brokers, and middlemen, and let software run the markets. So who's actually building this? Some of the biggest names in both traditional and crypto finance. BlackRock and Franklin Templeton are experimenting with tokenized money market funds and bonds. MakerDAO, a leading DeFi protocol, is backing its stablecoin DAI with tokenized real-world assets. JP Morgan has launched its own blockchain platform for institutional asset tokenization. Even the Monetary Authority of Singapore and the European Central Bank are exploring how to bring bonds and currencies on-chain. And it's not just about finance. Some startups are tokenizing carbon credits, supply chains, music royalties, and even agriculture, with blockchain serving as the digital infrastructure for trust, transparency, and settlement. But here's where it gets tricky. Tokenizing a real-world asset doesn't magically eliminate the complexities that come with it. That Manhattan building still needs maintenance, insurance, legal compliance, and tax filings. The token itself is only as reliable as the legal structure and custodians behind it. And if something goes wrong, if the property is seized, the manager disappears, or the smart contract is flawed, who do you call? A blockchain can't fix a broken court system. So while the technology enables efficiency, it also creates a new layer of abstraction and risk. When you hold a token that represents a real-world asset, what you're really holding is a promise that someone, somewhere, has linked the digital to the physical in a way that's legally enforceable and economically fair. And those promises can be broken. The question is, who's responsible when they are? As we move into the next chapter, we'll explore why so many powerful players are pouring resources into this trend, and what they're not telling you about the risks involved. Stay with us. Chapter 2, The Hype and the Promise, Who's Driving the RWA Boom? If you've been following the financial headlines over the past year, you've probably noticed something. The loudest voices championing real-world assets on blockchain aren't just crypto-native startups anymore, they're global financial institutions. Why? Because after more than a decade of watching blockchain evolve on the sidelines, often with skepticism, traditional finance is waking up to the fact that tokenization might be the bridge they've been looking for. Not a revolution that replaces them, but a tool that extends their dominance into the digital age. Let's start with the narrative. The pitch is seductive. Tokenization will democratize access to high-value assets. It will unlock trillions in global liquidity by making illiquid markets tradable. It will increase transparency and reduce settlement friction. It will help banks, asset managers, and governments reach previously untapped investors, especially in emerging markets. In other words, it's progress wrapped in innovation. BlackRock CEO Larry Fink, for instance, has called tokenization the next generation for markets. JP Morgan has been quietly building its Onyx platform, which settles billions of dollars worth of tokenized assets daily for institutional clients. Goldman Sachs is piloting tokenized bonds. Even HSBC and Citi have entered the game. Meanwhile, crypto-native platforms like MakerDAO, Centrifuge, and Maple Finance are integrating real-world assets into DeFi protocols to reduce reliance on volatile crypto collateral. Their hope? That RWAs will bring stability and legitimacy to decentralized finance by connecting it to the world outside the blockchain. And regulators? Surprisingly, they're not resisting as hard as they used to. Why? Because tokenizing regulated financial products like bonds or funds fits neatly within existing legal frameworks. It doesn't threaten the system, it upgrades it. Central banks are exploring tokenized cash and bonds. Governments are eyeing tokenization for more efficient fundraising. And institutions see a future where they can issue and trade assets globally, compliantly and instantaneously. In short, everyone sees opportunity. For banks, it's about reducing costs and increasing control. Instead of relying on dozens of intermediaries to settle a trade, they can use a single blockchain ledger. Instead of managing siloed databases, they can interact with a unified layer of digital truth. This could slash operational inefficiencies, speed up settlement times, and reduce counterparty risk. For asset managers, tokenization opens new markets. A luxury real estate developer in London can now sell fractional ownership to investors in Singapore or Sao Paulo without ever issuing a stock or filing for an IPO. Private equity funds can become more liquid. Infrastructure projects can find global backers. And for governments, tokenization could bring greater transparency to public debt, spending, and carbon markets, all while making capital flows more efficient and traceable. But here's the part of the story that isn't talked about as often. All this talk of democratization and access sounds noble, but in practice, many of the tokenized products being created today are only available to accredited investors, not the average retail trader. Institutional capital is driving this wave, and institutional players are setting the rules. In fact, some of the most high-profile RWA platforms are permissioned blockchains, systems where only pre-approved actors can participate. That means no open networks, no decentralized consensus, and limited transparency for the public. In other words, the blockchain is being used less to disrupt power, and more to consolidate it. What's more, many of these tokenized assets aren't actually being settled in crypto at all, they're settled in fiat currencies, via traditional custodians, and within legacy legal systems. The blockchain is just a technical layer, a back-end upgrade to the same old structures. So while the hype promises a revolution, the reality looks more like a repackaging of traditional finance, faster, yes. More efficient, perhaps. But still largely under the control of the same players who ran the game before. Of course, that's not inherently a bad thing. But it raises important questions. Who controls the data? Who enforces the rights of token holders? What happens when something goes wrong? And who decides which assets can be tokenized and who gets to invest? These are not just technical challenges, they are questions about power, access, and trust. Because behind the flashy interfaces and institutional press releases lies a deeper issue, tokenization may not level the playing field. It may just redraw the lines, digitally, globally, and quietly. In the next chapter, we'll look beneath the surface, at the hidden risks and fragilities of tokenized real-world assets. From legal uncertainties to liquidity traps and centralization threats, we'll examine why some experts are sounding the alarm before this new system becomes too big to fail. Stay tuned. Chapter 3: The Risks Beneath the Surface, Regulation, Liquidity, and Control. On the surface, the tokenization of real-world assets promises everything investors want: access, efficiency, and yield. But beneath that polished exterior lies a much more fragile foundation, one riddled with unresolved legal questions, liquidity illusions, and centralization risks that could undermine the very system it claims to improve. Let's start with the legal reality. When you buy a token representing a real-world asset, what exactly do you own? Do you have legal title to the underlying asset? Do you have enforceable rights in a court of law? Or are you merely holding a claim on a claim, one that depends on the honesty and solvency of a third-party issuer? The truth is, in many jurisdictions, tokenized assets exist in a legal gray zone. There is no global standard that clearly defines the legal relationship between a blockchain-based token and a real-world object. This means that your rights as a token holder might be extremely limited, especially in a dispute or bankruptcy. Even when legal frameworks do exist, they're often inconsistent. One country may recognize a tokenized bond as a security, while another may not. Some regulators treat tokenized real estate as property, others as investment contracts. This patchwork creates regulatory arbitrage, where issuers choose the most favorable jurisdictions, not necessarily the most transparent or protective for investors. Then comes the issue of custody. If a blockchain token says you own part of a building, someone still has to hold and manage that building. That means dealing with property managers, custodians, trustees, or legal entities who have off-chain responsibilities. If those parties fail, your token may be worthless, regardless of what's written in the code. Next, let's talk about liquidity, the supposed superpower of tokenization. The sales pitch is that tokenizing real-world assets makes them instantly tradable and more liquid. But in practice, liquidity is not guaranteed just because something is on a blockchain. For an asset to be truly liquid, there must be buyers, sellers, market depth, and trust. Many tokenized assets today trade on fragmented or lightly regulated platforms with little transparency or volume. Worse still, some of these markets are driven by speculative hype or artificial incentives, rather than organic demand. This creates a liquidity mirage, where price discovery seems smooth, until the market turns and buyers vanish. We saw this in DeFi during the crypto winter, and the same dynamics could plague RWAs if trust breaks down. Centralization is another major concern. While the blockchain industry prides itself on decentralization, many RWA projects rely heavily on centralized entities to issue tokens, verify ownership, manage assets, and settle disputes. That introduces single points of failure. If the issuer gets hacked, goes bankrupt, or acts maliciously, token holders may have no recourse. For example, if a company tokenizes real estate and promises rental income to token holders, but then defaults on property taxes or disappears, what happens? The blockchain may still show you as a holder, but the asset, and your rights to it, are gone. Code can't enforce property law or chase down a missing CEO. This raises a deeper issue of trust. One of blockchain's founding principles was to remove the need for trust in centralized intermediaries. But with RWAs, we're seeing the opposite. Blockchain is becoming a wrapper around traditional trust-based systems, with no real improvement in resilience. Smart contracts can only enforce what they're programmed to do. They can't account for fraud, human error, or complex legal nuances. And once RWAs are tied to institutions, custodians, or courts, the blockchain becomes secondary to the real-world enforcement mechanisms, which are often slow, opaque, or inconsistent. There's also the question of systemic risk. As more RWAs get tokenized and integrated into digital finance, a failure in one part of the ecosystem could cascade. Imagine if a large tokenized real estate platform collapses. If its tokens are used as collateral in DeFi, the contagion could spread through lending protocols, stablecoins, and exchanges. What began as an isolated failure could become a systemic one, especially if regulation lags behind. And finally, we must consider access and inclusion. Despite the rhetoric of democratization, many RWA opportunities remain closed to retail investors. Most tokenized private equity, real estate, and credit markets are restricted to accredited participants. The public blockchain is open, but the assets themselves are still gated. So the benefits of tokenization may ultimately flow to the same institutional players who already dominate traditional finance. In short, the risks of RWAs on blockchain are not technical, they are legal, structural, and systemic. Tokenization doesn't remove risk. It transforms it into a new form, one that is often harder to see, regulate, or mitigate. The question is not whether RWAs will succeed, they're already gaining traction. The question is, who builds the rules, who controls the infrastructure, and whether we're creating something truly resilient, or just another fragile tower built on digital sand. In our final chapter, we'll explore who stands to gain and who might lose as RWAs reshape the future of finance. Chapter 4: Who wins and who loses in the RWA ecosystem. In every financial innovation, there are winners and losers. Tokenizing real-world assets on the blockchain is no exception. While it's often marketed as a technological equalizer, opening up access to elite assets and markets, the deeper reality is more complex. The benefits are not evenly distributed. So, who actually gains from this new system? And who gets left behind? Let's start with the winners. First and foremost, financial institutions. Big banks, asset managers, and legacy players are some of the biggest beneficiaries of the RWA boom. Tokenization allows them to modernize their back-end systems, cut operational costs, and unlock liquidity, all while staying in control. They can take old assets and give them a new digital life, charging new fees and reaching new markets without changing their fundamental business models. For example, a private equity firm can tokenize portions of its fund to attract international investors who otherwise couldn't participate. Real estate investment trusts, REITs, can issue fractional tokens to retail investors in developing markets. And investment banks can structure synthetic products backed by tokenized debt, opening up layers of financial engineering that were previously unthinkable outside traditional markets. These players don't just gain efficiency, they gain reach. Tokenization gives them access to borderless capital, continuous trading, and programmable finance. It's a way to tap into the digital economy without giving up their institutional advantage. Second, crypto platforms and DeFi protocols that embrace RWAs also stand to benefit. Projects like MakerDAO, Goldfinch, and Centrifuge are integrating tokenized real-world credit, real estate, and government securities into their systems. This allows them to reduce reliance on volatile crypto collateral and connect with tangible cash flows. For these platforms, RWAs represent credibility and stability. They can attract institutional capital, lower risk profiles, and comply with regulations more easily. In the long run, the integration of RWAs could be the key to DeFi going mainstream. Third, high net worth individuals and accredited investors gain early access to fractional ownership in assets that were previously illiquid or restricted. Tokenized luxury real estate, private debt instruments, and venture capital funds become easier to buy, sell, and trade, often with fewer barriers and faster settlement. And what about governments? Some of them stand to benefit as well, particularly those that are forward-looking in regulation. Countries like Singapore, Switzerland, and the UAE are already positioning themselves as global hubs for asset tokenization. This brings capital inflows, innovation, and influence in the emerging digital asset economy. But not everyone wins. Let's talk about the losers, or at least those most at risk of being marginalized. Top of the list, retail investors. Despite the narrative of democratization, most high-quality tokenized assets, like private equity, institutional real estate, or credit portfolios, remain out of reach due to accreditation laws and regulatory limits. What retail investors often get access to are lower quality, higher risk tokenized assets that lack transparency or proper legal structure. They may be enticed by promises of high yield or fractional ownership, only to find themselves in thinly traded markets, locked into complex structures with little recourse if things go wrong. In other words, retail investors are being offered access, but not necessarily protection. Next are small asset originators and property owners, who might see tokenization as a way to raise capital. While the tech is promising, the the onboarding costs, legal complexity, and regulatory uncertainty make it difficult for smaller players to compete. The result is that most RWA platforms are designed for scale, favoring larger, institutional issuers who can afford to navigate the maze of compliance and technology. There's also a risk for emerging economies. While tokenization could, in theory, help small investors access global capital markets, in practice, it may deepen existing inequalities. Wealthy nations with strong institutions will attract the best quality tokenized assets. Weaker jurisdictions may become dumping grounds for riskier instruments. Just as we've seen in past financial cycles. Even within crypto, not everyone benefits equally. Decentralization maximalists may find themselves sidelined as RWAs bring more centralization and KYC requirements. Permission chains and regulated platforms reduce censorship resistance and privacy, core values of the original crypto movement. And finally, there's a broader systemic risk. As tokenized assets become interlinked with both traditional finance and decentralized platforms, contagion becomes harder to contain. A failure in one corner of the market, say, a tokenized debt default or a smart contract exploit, could ripple through both worlds, affecting users and investors who never touched the original asset. So, where does this leave us? The tokenization of real-world assets is not inherently good or bad, it's a tool, and like any tool, its impact depends on how it's used, who controls it, and who is protected or exposed by its design. The challenge is that while tokenization promises openness, it often reinforces existing power structures. It promises efficiency, but may conceal complexity. It promises access, but may shift risk toward the most vulnerable participants. In the end, the real question isn't whether RWAs will succeed, they already are. The real question is, will they create a more inclusive financial system, or simply a faster, shinier version of the old one? As we move to the final section of this video, we'll reflect on what all this means for the future of finance, and for you. Conclusion: a brave new system or just old finance in disguise? Real-world assets on the blockchain are being called the next major leap in financial evolution, promising a more inclusive, efficient, and borderless system. And from a distance, the vision is compelling. Tokenized real estate, fractionalized bonds, instant settlement, global access, transparent ownership. But when you look closer, a different picture begins to emerge. We've seen how institutions are rushing into the space, not to disrupt finance, but to digitize control. We've examined the legal and structural blind spots. From unclear ownership rights to liquidity illusions and regulatory fragmentation. We've unpacked the winners and losers, and how tokenization may ultimately re-centralize power in a digital wrapper, leaving retail investors on the fringe. This isn't to say tokenization has no value. It absolutely does. There are real gains to be made in back-end efficiency, settlement speed, and global access, especially in markets plagued by bureaucracy and inefficiency. And in the long term, blockchain-based infrastructure could reshape how we trade, own, and interact with value across borders. But here's the hard truth. Tokenizing real-world assets doesn't fix the core problems of the financial system. It transfers them, sometimes to new actors, sometimes to new platforms, and often to users who don't fully understand the risks they're inheriting. What's being marketed as a revolution might, in reality, be an elegant upgrade to the status quo. One that preserves existing hierarchies while offering the illusion of decentralization. So where does that leave you, the individual investor, the builder, the policymaker, the curious observer? It leaves you with a responsibility to ask better questions. Ask who is issuing the token. Ask what rights it gives you. Ask where the asset is custodied, how it's governed. And what happens if something goes wrong? Don't be blinded by the promise of access or high yield. Understand the trade-offs between efficiency and control, transparency and complexity, decentralization and compliance. Because the future of finance isn't just about technology. It's about designing systems that align incentives, distribute risks fairly, and protect those without institutional power. Real-world assets on blockchain might be a step in that direction. Or they might be a trap, disguised as innovation, built to serve the few. Ultimately, whether this becomes a true revolution or just a digital rebranding of old finance depends not on the technology itself, but on how we choose to build, regulate, and use it. So stay informed, stay skeptical, and stay ahead of the noise. If you found this video insightful, make sure to like, share, and subscribe to Money Minded for more deep dives into the future of global finance. We break down the narratives, unpack the systems, and tell you what the headlines don't. Thanks for watching, and remember, in a world where everything is being tokenized, understanding the value behind the code is your greatest asset.